I think we have some exciting questions, hopefully questions that the audience will find useful. And again, as Sontran mentioned at the beginning of the presentation, you do have the possibility to ask questions, and that's on the Bench app, where you can access the agenda and then this particular conference and go through the live interaction. I'm just going to go ahead and open it up with Daniel, perhaps. So we've seen the figures, we've seen how active the space is, and I think, look, for Accor, Daniel, as the second most active operator, how important is the Middle East and Africa for you as a region?
You sort of the stats speak for themselves. For us, the Middle East and Africa is the single largest region globally for our signings. It's also the most active region in terms of our signings of standalone residences, which we can spend some more time talking about. And the two countries which really lead the charge, the UAE, with Dubai first, but now also closely followed with Abu Dhabi and Ras Al Khaimah, and Saudi Arabia. So very, very much key focus points. They're also the sort of region in the world for which, from a sales perspective, are the most active right now, and generating the majority of the sales value, the 2 billion that Jeff mentioned earlier, is actually coming right now from Dubai in particular, followed by the Kingdom.
So is it luxury brands predominantly in this region? I know luxury has been a very active segment in this region. Is that as well for your brands, what you're seeing for your portfolio of brands? You said 20, I think 25 brands that are active in residence?
25.
25 brands. Yeah.
So 25. I would say historically, yes, but very much as the data you showed earlier shows, we've signed a growing number every year of properties in the premium segments, some even in the mid-scale segments, none on the co-located in the mid-scale. And those are the ones which are selling equally successfully to the luxury brands. Because of, to Jeff's point earlier, that reach to a different buyer demographic and psychographic. There is, not everybody wants to buy a Four Seasons, a Ritz-Carlton, a Raffles. There are a lot of buyers out there who don't even want an SLS or a W, but who are going to be much more interested, for example, in buying a Hyde.
Okay, all right, interesting. Rashed, Royal Madinah. You're embarking on your branded residential journey, or you plan to embark on your branded residential journey. You've read the Savills reports. You've heard, you've heard how active the region is for Daniel. Do you foresee any risk with branded residences?
Sure. Yeah. Thank you, Rico. There are. I mean, essentially, branded residence is a residential real estate product, and it needless to say, it comes with all the risks associated with a real estate investment. However, there are a few risks which are peculiar to branded residence. So if you can group it different ways, but if you look at market risks and project risks, and we'll focus on the market risks for this purpose, for this discussion, because project risks are project specific. From a market perspective, you definitely break it down into the first principles, first questions you ask, supply risk, and demand risk, and other aspects like pricing and sales, etc. But first you start with supply and demand, and why that's important in the context of our conversation, especially focusing on Kingdom, is that it is a very small market right now, the branded residences, and there are very few existing properties to really look at and take lessons from or use as benchmarks. And that puts developers, at least at this point in time, at a disadvantage, right? So, what's the current supply? There is not much. What is the future supply? There is a lot of in pipeline, but there is a lot of unconfirmed data. And is there going to be a future supply? These are the essential questions you ask, so to cover the risk. And then you asked a question about the about demand, and definitely that's again, you look at the market. You don't have a lot of benchmarks. You don't have a lot of sales trends, etc. to look at. So you need to start from first principles. So that's what we did for our, setting our branded residence strategy, and Savills was part of that journey. Thanks, Rico. And we went back to the market, did an extensive market study, a global survey, and looking at more than 25 countries covering 70% of the Muslim population, which helped us estimate the potential demand for branded residences in Madinah. And that also gave us the window to understand the needs and preferences of these buyers, local and international. What do they want? What type of product, etc. So this is something critical to cover your market risks. And the other thing that stands out, and we must discuss today, is the in the context of, again, Saudi market, is the regulatory risk. Right? So there has been a lot of work done over the last couple of years in terms of laws and regulations. And new regulations have come out allowing foreign ownership and more clarity on it. But there is still a lot more work being done, and we're still waiting for example, the foreign ownership regulation in Mecca and Madinah, and it's hopefully coming out soon. And this is critical for not just our project, but for the wider ecosystem of branded residence projects to be successful. Yeah. Right? And there need to be favorable conditions in the market, regulatory conditions in the market for foreigners to come in and buy and invest, especially if you are focusing on outside foreign markets. Right? So these are the two main risks that I would highlight. Then there are obviously other risks, which I was mentioning about. Something which is peculiar to branded residences, unlike a typical residential product, obviously is relating to the branding and operations, right? So especially in the later years, once the property is launched, you might get into situations where the owners do not appreciate, or there is gap in terms of expectation from the owner and the service delivered by the operator or even the developer. There is the gap in there. A lot of times, it might be down to the service charge. At the end of the day, money talks.
Yes.
And this is a risk. And why this is a risk here is because, again, this is a small market. This idea of service charge, especially with the operator involvement and the and ad hoc, the a la carte services and mandatory services, this is not tested much in this market. So the risk is basically we don't know how sensitive the market is yet on the service charge issue. So we'll know when the market grows.
You'll find out.
We'll find out.
I think we'll all find out. I think we'll all find out together. I think if anything, so sure, there's risks. I mean, the concept has been proven around the world, and there's markets where it's a little underdeveloped, but there's definitely potential there as well. So indeed, there are risks, but because it's such a proven concept, then I think that permits a certain level of optimism. You mentioned Mecca, and Daniel, I know that you've got the Novotel residences in the holy city of Mecca, and luxury residences, I mentioned before, are still predominant. How do you choose the right brand for the project?
It comes down to the analysis done through the third-party market studies, discussions with the developer about what their ambitions are, us looking at the site itself. Firstly, is the site location that from a residential perspective lends itself to an ultra-luxury brand, a luxury brand, mid-scale, and so forth. And then the analysis of the study sort of really drives, firstly, what brand? Is it lifestyle or is it classic? And then also drives the programming of the dedicated residential amenities. It also drives whether or not it's a property on which we would offer a rental program. And it also informs, obviously, the residential unit mix, sizes, and prices. We think through very carefully, to Rashid's point earlier, about what the impact is going to be in terms of service charges. When you have a standalone, you really need to sort of supercharge the dedicated residential amenities to be able to bring the brand to life. In a co-located project that is more in the mid-scale segment or the premium segment, where there's a heavier emphasis on second home ownership and rental program, you obviously don't need the same extent of residential amenities that are dedicated for the residence owners, because that's just going to ultimately sort of increase service charge, reduce their return, and that's not how they plan to use their properties. So that's sort of really how we go about assessing which brand or which tier first, and then which brand makes the most sense.
Got it, clear, okay. And so Rohan, you operate in a luxury space at India Hotels Company. You've got the Taj in that luxury space. How do branded residences for you, how do they deliver value to the residence owners?
Yeah, first of all, good morning, everyone. I'm part of the Indian Hotels Company, more popularly known as the Taj Hotels here. And it is one of the oldest operating companies of the Tata Group, which is present in the region since the 70s. And Rico, to answer your question, for us, it is not just a real estate play. We look at it as an extension of the luxury hospitality experience. So from a developer's point of view, we see the developer benefiting from upfront premiums when they sell the residences. We look at the residential unit owners. They tend to benefit a lot out of becoming part of one of the best luxury brands in the world, and being in that environment which is, let's say, a luxury lifestyle. And of course, for us, there is long-term annuity income out of the residential product. And also, we get to take our brand to places which are AAA locations, where just a hotel might not be feasible.
Great, excellent. And so would you do standalone residences? Would you find, so where you don't have a hotel, where the residences are really operating on their own, where they're standing on their own, would you do a standalone residential development under the Taj brand?
So Rico, our strategy for the Taj brand is always to operate in the luxury, ultra-luxury space. Yeah. And while we do have several other brands in India, at least for markets beyond India, we want to only operate in the luxury space. And when it comes to standalone residences, we ask ourselves a question, can we uphold the values, the consistency, the standards of Tajness, which we have perfected over past 120 years? And if we can answer yes, then maybe. If we can't, then no. I mean, I heard a lot of discussions over past 2 days, and Jerry mentioned about quality of life, quality of living, in addition to what the branded residences are offering as an environment, so that people can subscribe into it. Nick also mentioned that quality, consistency, standards are extremely important. Look at the Taj. We believe that the Tajness has to be felt, lived in.
Tajness?
Tajness.
That's a word.
So yeah, I mean it's our proprietary service philosophy. It's a 360 degrees outlook. So for us, it has to be lived, it has to be felt, it has to be experienced, and it cannot be just labeled onto a building, or it cannot be just licensed. So we are very careful. We spend a lot of time in evaluating the location, like Daniel was mentioning. We actually evaluate also the quality of partner who we want to partner with, and obviously the scope and scale of the development. For us, it is a long-term luxury bond or a lifestyle bond we enter with our residential unit owners. So it's not just a quick real estate play. We are not doing that.
Yeah, I mean, they trust the brand. They have confidence in the brand. They expect the brand to deliver. It sounds like you're not saying no, you wouldn't do standalone, but you probably look at it very selectively, and it needs to make absolute sense in the market for all the stakeholders. Which is the exact right attitude, which is the exact right way to approach probably not only standalone, but any branded residential development, for that matter. Daniel, you've done standalone residences, and you mentioned before service charges are, and so where you have co-located, you don't have, so Jeff mentioned before hotel economics, improved hotel economics, but that also means more convenient per se, perhaps more affordable or more commercially competitive residential economics. Service charges in standalone, are they contentious?
They're not contentious typically once you get the property open and operating. They can be contentious in the initial discussions with the developers, and that sort of stems often from a lack of understanding of how exactly you're going to be able to successfully operate the property. Whilst at this one side, yes, you don't have the same immediately adjacent hotel, by and large, with some exceptions, we would only do a standalone if we already have a hotel under that brand within the market, which means even if you're not able to directly have the director of engineering and their team from the hotel who literally just walk across or walk within the same building, you'll still be able to have other aspects that you can cluster, like HR and other back-of-house aspects, so that you can certainly sort of, valet contracting, security. You're still able to put a bigger contract through to a particular company. That's going to deliver value for money for the residence owners by having something that's procured at a cheaper cost than if it was purely 100% standalone without the brand, that they had to do that themselves. Mm-hmm. Ultimately, we spend a lot of time every single year drilling into the details of our service charges. When our directors of residences are preparing the service charge budgets, they will always, we review them together. Part of the exercise is they need to then also, at every AGM, they start off, before they even go into the numbers, by showing the residence owners, these are the service charges at other comparable properties within our market. These are resale prices at our residences versus other residences. Here are the rental prices for long-term rentals at our apartments compared to the other ones. And here's a summary of the various activities that we have organized for you, our residence owners, over the course of the year. So yes, while service charges are naturally going to be higher for a branded residence and always then for a standalone branded residence, they still, for our residence owners, deliver value for money. And if they didn't, the big difference with a branded residence compared to a hotel is the homeowners associations in the majority of countries around the world have the legal right, if they're not happy, to kick out the brand. Right? Then, of course, there are costs implicated, but they can in a much more simple way than the hotel owner could get rid of a brand. So we're very, very conscious of that. And over the last 25 years in which we've operated branded residences, we've never once had an association turn around to us and say, guys, service charges are just too ridiculous. We're not happy. That's it.
Yeah. How do you get the amenity program right? Because you don't have the adjacent hotel where, depending on the size, depending on the inventory of the residences, you don't necessarily have access to direct access to a spa, even as a member of the general public, access to a spa, access to a gym, access to swimming pools, and how do you get the amenity program right?
Well, you program it right based on the brand. So that, again, coming back to the brand is based on the analysis of the buyer profile. Then you sort of go, let's take, for instance, the Rixos. Rixos standalone in downtown Dubai. Rixos as a brand is a brand that is very heavily focused on family and on wellness. So the particular focus points we put there, you've got running track, paddle tennis courts, indoor gym, outdoor gym. We've also got a fantastic kids club, indoor kids club, outdoor kids club, golf simulator. So you're putting a lot of focus on the amenities which will appeal to the buyer profile that is interested in the Rixos brand. At the same time, you will also look at, is the buyer profile going to lean more towards purchasers in their 30s and 40s who have younger children? Then you really need to make sure you've got a kids club. Is your buyer profile on the particular project going to lean itself more, which would be the case typically in most Raffleses and Fairmonts, lean themselves more towards buyers in their 50s and 60s, in which case a kids club is a waste of space that costs money in the service charge and is never going to be used. So instead we look at what else can we program there. And we're constantly evolving. You look at most standalones now, and even co-located, you have pet washing stations. So as an a la carte service, people can come, have someone come, wash the animal, groom the animal. In urban locations, you've even got the little running tracks indoors, so that you can actually take your animal, go for a run, do their stuff. You haven't got the spa, no, but you're able to have treatment rooms. You can have multi-purpose treatment rooms so people can get their hair done, a hairstylist, manicures, pedicures, all of that within the convenience of your building. And the way in which we articulate the service offering then also brings the brand to life in terms of the type of events that we'll organize. In a SLS, we're much more likely to be bringing in, if you've got a concert taking place, we'll try to get the musician to come to the SLS to do a talk, a meet and greet with the residence owners. At the Raffles residences in London during the Wimbledon tennis tournament, we had a couple of the tennis players who came over for a meet and greet with the residence owners. So you bring the brand to life through ways which are more sort of bespoke to the DNA of that brand.
Got it, clear. Yeah, you mentioned pet grooming, which is for me personally important. And I remember seeing the Ritz-Carlton residences in Miami where they had the pet grooming, very well set up, great. And we were at the Four Seasons in Bangkok last week, also pet grooming important there. So it's not, you have a wide range of amenities from fur storage to the most common, which is the residence lounge or the fitness center, the swimming pool. But you have a very diverse range, and it very much is market driven, I suspect. So Rashed, as you're gearing up to sell your residences, the marketing and sales process, the operations process, you touched on it briefly before. What are you doing as the developer versus what do you expect the brand to do?
So we are in early stage now. So in terms of the hotel branded residences that we have planned in the initial couple of super blogs, we are in the design phase. In fact, one of them we've completed design. The others we've finished schematic. So at this stage, it's very much driven by us. However, with a lot of contribution from operators in terms of technical service and defining the brand standards and defining the value proposition and agreeing on the facilities and what we offer, right? And then I think in the next few years, I think that's going to continue that way, which is we will be driving the process in terms of developing the property with the involvement of operators. I think it then will flip, obviously, in the later phase when we are about to launch. And obviously, we will rely a little bit more on the operators during the sales phase, obviously, because that's one area where operators can add value in terms of bringing in their loyal guests or people who have been part of the branded residence community for those brands. And that's something we would definitely leverage on. And look forward to the operators to contribute to into that process. And then I think the operator will operators the role really kicks in. The heavy lifting is rather once the property is about to be launched.
Got it. So more heavy lifting from the developer during the marketing and sales with support of the brand.
Absolutely.
It's called a team effort, and then once it becomes operational, more that starts to shift a little bit to the brand, where again you bring the brand to life, where you are able to deliver on the lifestyle that
Yes.
branded residences can afford.
We would ideally want to take the backseat, right?
Yeah.
And which is happening in other markets. I think there are multiple models, but we have seen this happening in markets like Dubai, for example. A lot of developers are really taking the backseat, and obviously operator is running the show. They're managing, especially the common areas. But then there is the community manager who actually runs the administration part of it on behalf of the hotel owners. So developer has much less active role. That's something we would foresee for ourselves as well.
Got it. Okay. And Rohan, what do you guys do at Taj to support the developers? How do you convey the Tajness to the developer?
So within the Taj ecosystem, we have 2 or 3 different sort of programs.
Okay.
One is the Chambers membership program. So Chambers is an invitation-only program. So you need to be invited to be part of the program. It's a global program. It's a club across all our hotels in the world. So it's important that you need to be invited. So you are qualified before you are even invited. And it's such a strong and powerful database of people. So we sort of support our developers to have an engagement with such prospects who can potentially come and buy. Could be a second home or the first home or the third home. So that is, of course, one. There is also the power of loyalty. So what has happened over the past few years is the Tata Group has combined all the loyalty programs into one, which means we used to have about 10, 12 million members as a hotel company. And off late, the Tata Group combined all of that, all the B2C companies, be it the airlines, be it the grocery, be it the supermarkets, be it the pharmacies, all of that. And now we have reached about 120 million members. Now what has happened because of that is the program allows extreme fungibility when it comes to exchanging dollars. So you can have a meal in a hotel, next day you can buy grocery, the third day you can buy medicine, the fourth day you can buy a plane ticket, and it is all redeemable amongst the group. So that is something which is very unique. I have not seen a program like that. There are very powerful programs globally, but they are all third party. So that is something which is unique. Also what we do is we do roadshows along with the developer in key source markets. And that sort of helps get the right kind of people, because we don't want prospective residential buyers who are just coming in for a quick trade. See, it's a very personal space when it comes to luxury living. We see people who make it their home, and also not necessarily they are comfortable with putting that as a rental program. So what happens, because there's so much of personal stuff, there's so much of art, it is not easy to move everything away. Yes, in theory you can, but it's not easy to put everything away and then make it available. Also, the prices are very high. So you don't want someone to pay $400, $500 for a night and stay next to someone who has paid millions of dollars. So that is always a unique challenge which we try to solve. But I think there's a bunch of things which we do.
Yeah. Okay. You mentioned rental programs. So you do rental programs, and I appreciate that someone who's paid a significant amount of money for privacy, for exclusivity, for safety, does not want to see their neighbor change every 3 or 4 days.
That's true.
So how do you decide where and when and how to do rental programs?
So rental programs work. It could be a mandatory or an optional, depending on what kind of structure we have. We may run a rental program. But what we like is, we like the developer to be vested in it. So we don't want, that's why we always want a hotel, or we always want a co-located environment, because we need to ensure that the long-term objectives of everyone are aligned. So when it comes to rental program, we're happy to run it, but we also do leaseback programs, which is like an investment product. So some American companies may not do that because of securities law, etc. But we have found a way around it.
Okay. All right. Rashed, Daniel, any views on rental programs?
We are looking at a rental program.
You will do,
We will do rental program, inshallah. The idea is, it all goes back to an understanding of what our customers want, right? We did a very thorough study, and which pointed to the fact that a good percentage of buyers who are interested in Madinah are looking at investment, pure investment, or investment plus second home. So we don't want to let go of that segment. And there is another, and then there are obviously a few, small percentage of people who want to buy purely as second home and they want to keep it. or even first homes. But considering the location and where we are, especially in the front row of our project facing the Haram Plaza, which is very much a transient location, we don't see a lot of people living there permanently. Right? There might be a few who might do. Actually, in fact, we already have some examples in the current market, not in our project, obviously. In another project, I've heard when I spoke to people that there are people who have bought properties there and apartments in a residential building, which it's kind of branded residence, but not international brand. And these are retirees. And they spend 3 months, 6 months there or more, and that's probably an emerging market. And there is obviously the religious connection to why people want to live next door to the masjid. They don't mind the traffic probably. There's a greater purpose for living there, which is fine. So essentially, coming back to your question, the rental program will help us address all the different market segments. The way we have done is we have obviously a differentiated portfolio of branded residences. There are luxury assets on the front row, and then there are upscale and upscale properties. So we see that based on how the market functions and the preferences of ultra high net worth and high net worth individuals, we see these luxury properties probably attracting more of second home owners and those who may not want to put it in the rental program. And the lower scale, upscale properties attracting more of investment-driven buyers. That's how we see it. But this will have to play out, right? Because again, having seen other markets how they started off and then how they have now after 10 years, transformed into, it could be a completely different mix later on.
Yeah. And Daniel, what about you? Rental programs, pro or con?
Rental programs and generally pro when it makes sense. So resort locations, 100%. With regards to mandatory rental programs, it's typically only where the number of hotel keys by itself is insufficient to make the hotel sufficiently viable, or if the zoning planning conditions require a mandatory rental program, which is the case in some jurisdictions. There are a very small number of exceptions in other locations where simply debt funding is completely unavailable. But to Rohan's point, the second you go down, and I know that Rhonda Mustafa will talk on this on the legal panel, the second you go down any form of mandatory rental program, you go straight into the rabbit hole of securities laws, and it doesn't apply. The classic thing is, yes, but securities laws don't apply in my particular country. I can sell a mandatory rental program, but that's just not how the way securities laws work. They work on a global basis. So we're very, very careful around any mandatory rental program.
Okay, all right. We do have a question here from the audience. So, and this is an interesting one. So once all the glamour once the glamour from the sale is over, once the developers made the money, sold all the inventory, hit the premium of 33%, once the residence owners have bought it, they're excited, they've got their new home, whether it's primary or second home. The brands made their fee. Everyone's in that initial honeymoon period. Once that's over, 10 years down the line, 15 years down the line, once you have 200 residence owners, how does it continue to operate? How does it continue to be a Taj residence or a Raffles residence? Anyone, I'm sure you'll all have views, but Rohan, if you want to answer that question first.
Look, for a Taj residence, it is very simple. We see it as an end use product. What we have noticed is there is a lot of crossover benefit which comes in because the residence owners, the utilization of hotel products is very high, be it F&B, be it dining at home, be it the wellness, be it butler program, whatnot. So that sort of benefits the hotel a lot. And these people are actually the flag bearers or the torch bearers of the brand. And we have seen that work very well.
Yeah, yeah. Daniel, how do you, I mean, you've got resale values as well if residence owners want to sell, and obviously if you're maintaining the common areas to the brand standard and you're continuing to deliver that luxury quality, how do you see it 10 or 15 years? Is it still a Raffles residence?
100%.
Or a
If we look
Fairmont,
at, as you know, we're having discussions around getting resale price premium studies analysis done. So that right now the data is all focused very much on that initial price premium, but the branded residential market globally is very mature. It's been around now, as you showed, for decades. Buyers are not, people don't become very wealthy by being idiots. These are people who are very careful about their money, how they invest their money. They choose a brand. That brand is the ultimate expression of loyalty in terms of if you purchase into that brand. So to your point, we have standards, we have operating standards, we have design standards, and the governing documents very carefully make certain that the homeowners association has a legal requirement to maintain the property to those brand standards. So we, and it's not saying we ram down the throat of our association. We very much will spend time with them. We have carefully planned reserve studies to make sure that we're putting aside the right amount of money to be able to renovate the property to those standards. We will have discussions with the HOAs. Obviously, if it's co-located, it will be following the timeline where the hotel is being renovated. If it's standalone, it will follow the right time frame when the property, FF&E, in the common areas needs to be renovated. And we have discussions. We show them the data from third-party studies like yours that our projects, which are 10 years old, 15 plus years old, and have been renovated, they continue to sell at a resale basis for a significant price premium compared to the non-branded competitors. So they see day in, day out, two things: value for money and a lifestyle in the way their property is managed, the way they have an experience on property. But in addition, and to Rohan's point, on a global basis, we have the Accor owner benefits program for our residence owners globally. Marriott have got Onvia. We look after these residence owners as the highest category of VIP within our ecosystem, so that whenever they travel around the world, they are treated in a way that is very, very curated for them. So they experience that on property, off property, and from a financial perspective, they see the value in their properties being maintained for them.
Yeah, for sure. And I think that surely will be a key selling point as well in Saudi, in Madinah, where buyers of a branded residence there have access to a global. Branded residences are great locally, but they mean so much more internationally. Yeah. And I mean, for you, Rashed, how do you envision 10 or 15 years down the line, whether it's in your master community or even in Saudi in general? How do you see the dynamic? I know we're looking into a crystal ball. We don't know.
No, look, I had the same skepticism in the question. Before I went to and we went out to do a lot more market research and went out and met a lot of brand residence operators, spoke to owners, unit owners, and developers, etc. And that skepticism went away. I mean, obviously, this was mainly covering Saudi Arabia. It's a different landscape here, but it went away when we did a lot of this research in Dubai, and I was really amazed how well it worked. And the best properties there are asset managed like hotels, right? So, in the residence side, I didn't feel it like as a residence, or whoever went there, we didn't feel it like a residence. It was managed like a hotels, but it is personalized service, ultra personalized, because these guys are living there for a long time, and everybody know them, their pets, as you said. Yeah. And it was working very well. I'm not saying they don't have their share of problems, yeah, but it works very well for, and it's been working for many years. You can name it, a lot of brands which are active in Dubai. Not just ultra luxury, but even upscale brands, right? There are a few other things we observed, but we got a lot more confidence that this can work. But obviously, there are things that you need to fix. For example, the ownership structure, the titling, and all that stuff, and then the service, the service strategy, etc. But it can work if done properly.
Consistency and delivery, and so that's all key.
Absolutely.
Excellent. So with 10 seconds to spare, please join me in thanking my panelists, Rohan, Rashed, and Daniel. And thank you for joining us.